Hey, thank you for joining me today. I've got an important topic we're going to cover about how to value commercial real estate. My name is Mark Hulsey. I'm the managing broker of Results Commercial. We're based in Minneapolis, St. Paul, Minnesota, and we are a commercial investment boutique. So you guys, it all starts with valuation. This is it. If you can't value commercial real estate, you don't belong in the business, right? That's pretty straightforward. You need to know how to value commercial real estate, and that's what I want to talk with you about today, because it is not a simple process. There's a lot that goes into how to value commercial real estate. So let's talk about that for a minute. Because obviously, if you can't value it, how in the world can you go out there and effectively market it, put deals together, and project manage your transaction management? You gotta know at the very beginning, how do you value this piece of real estate? It takes somebody in the market to know what's going on. There's two approaches, you guys. There's the market approach and the income approach, and that's what I'm gonna talk with you about in just a moment. But think about this. There's a lot of people in my business that don't want to spend money on the data. You gotta have the data. If you don't have the data, it's pretty hard to know what's going on out there. Now, we've got a pulse for the market. We know what's going on out there because we're the folks that are transacting every day. Nonetheless, we count on information. We count on the data, and we spend a lot of money on it, and that's what we have to lean on as we're putting together our valuation pieces. Now, when you value a house, for instance, it's very different than when you value a piece of commercial real estate. When you value a house, you're going out there and it's primarily what's called a market approach, right? You'll hear that agent talk about pulling comps, and they're going to go comp that house. They're going to go find that 4-bedroom, 2-bath house that's similar to the one that they're, putting the valuation on. They're gonna say, hey, you know what, that 4-bedroom, 2-bath across the street that just sold for $325,000 2 months ago. So I think, Mr. and Mrs. Seller, I think your house is probably worth about $325,000. Pretty straightforward stuff. Yeah, you gotta weigh out some things about square footages or the pool in the back or the improvements that have been made on the property, but it's all based on comps. Now, in commercial real estate, we use comps too. We call that the market. That's our market approach. That's what that is, you guys. That's the market. But the difference is, here we're talking about per square foot. We're talking about that office building, that Class B office building in South Minneapolis is trading today for, we'll say $140 per square foot. We base our market on a per square foot basis. Industrial, retail, office, that's what we're looking at. Multifamily, certainly we do that too, but you'll hear things in multifamily saying, you know what? Those 20-unit buildings right now, they're trading for about, $95 a door. And we'll talk about a door, and that's like one of the little measuring posts when we get into multifamily. But market approach per square foot, that's what we're doing. We're saying, you know what? These 4 buildings, all in a similar area, similar size, are trading for $100 to $140 per square foot, and that's what the market approach is. What's the other approach? It's called income approach. Income approach is everything, okay? This is how we balance this out. This is how we're ultimately going to reconcile to guide our clients. And again, we are seller focused, so we get to do this every single day and work with our clients to say, we're gonna maximize the amount of equity you've got in your property, but we gotta price it right. So the income approach, how do we price that? Well, if it's a straight investment property, and let's just say it's a net lease property, obviously there's a tenant in there. Walgreens is leasing their building, and they're on a 10-year lease with their options to renew, and they're covering all their expenses, and that's a net lease, you guys. That's a pure net lease investment, right? Doesn't get any better than that in our investment world. And so we've got our net operating income. That's the amount of income that landlord is receiving every single year. That net operating income is going to be, we're going to start looking at what's called cap rate. I think I just did a video on cap rate not too long ago that you might want to check out too, you guys. Cap rate, that's how we measure the performance of a piece of commercial investment real estate. There's other measurements as well, okay? So we look at all different kinds of things from discounted cash flow, cash on cash returns, but cap rate is a really simple, easy way to measure return on investment. So what are we doing? That commercial property, that office building, that retail building. Let's take a retail building, for instance, okay? And we say, what's it start with? It starts with the income. And how do we establish the income? What's that retail building leasing for today? We have to reach into our data and start to say, That type of storefront, that 2,500 square foot storefront over there in that really nice area is going to have a base lease rate of, we'll say, $22 a square foot. And then on top of that, you've got some other CAM and operating costs. But it's the base rental rate that's going to start to establish what our income is. And that income is going to flow down to our net operating income. We take our net operating income, we divide it by a sale price to get to our cap rate. So just understand the two methodologies here. What's something trading for on the market per square foot? What is the income analysis telling us if we've got this fully leased up? And again, this is all done through spreadsheets, you guys, okay? This is not simple, just top of mind, let's just go figure this out. There's a lot of work. There's a few hours easily that goes into us having to value every single piece of commercial real estate so we can ultimately guide our seller clients on where we think we should take this to market. You know, it's interesting too. We happen to be in a changing market right now. So markets don't always just keep going like this, just perfectly moving along at a perfect little appreciation rate. Doesn't work that way. Markets can go like this. That's what they do. Do they typically head up? They do. Over time, of course, naturally, we're going to see that prices are always kind of increasing. But right now, as we're recording this video for you guys, we happen to be in 2020, we're in the midst of pandemic, and we're in a really unusual time. And it's during times like this that it actually gets pretty interesting in my business. You know why? Because suddenly, we're in a position where buyers are saying, gosh, I'm not so sure that building is worth as much as it was before. We've got office tenants that aren't in their buildings or they're not paying as much rent. We've got retail buildings that aren't operating. So suddenly we have a very tumultuous, crazy environment within commercial real estate. Not residential so much. Everything on the residential side is fine, but in commercial real estate, it's an unusual market right now. We might have sellers saying, I expect to sell my building for $150 per square foot because that's what the other buildings are selling for. That's what they've been selling for the past 18 months. We have buyers coming along and saying, I'm not giving you $150 per square foot. Are you kidding me? These are risky times. Mark, I want pandemic pricing. I want COVID pricing. What? You want what? I want pandemic pricing. There's too much risk in the marketplace. Maybe I'll give you $130 a square foot. So does it get a little bit tricky in these kinds of markets to say we've got comps up here, we've got buyers' perceptions right here, we've got our income analysis. It's not all cut and dry. This isn't super easy to figure out. This is tricky stuff. And you need to make sure that you got a broker that understands how to figure this stuff out and how to put these methodologies together and ultimately reconcile this. Now, when we're pricing real estate, a really big factor that we're using is going to be our seller's motivation. If I'm working for one of our lenders and we're doing a bank-owned property, they may say to me, Mark, I want this off the books by the end of the year. And I need to be putting together my disposition strategy, my pricing strategy in a way that I know I can sell that property and get it off the books by the end of the year. On the other hand, you guys, I can have a seller that says to me, you know, Mark, I'm not that motivated. And if you can get this done over the next 2 years, I'm good with that. So suddenly I could have seller motivation from, I want this thing done to, hey, get it done in the next couple of years. And seller motivation is everything. That's part of how we come up with some of our pricing strategies out there. So anyhow, you guys, I want you to understand that you need to make sure when you're hiring a broker, when you're interviewing a broker, they've got the data, they understand the methodology, they understand the disposition strategy when it comes to valuing the real estate. I hope that's helpful to you. I hope that sheds a little bit of light on the process that we have to use here in commercial brokerage. So we're all about real estate investing and commercial brokerage. If you like what I'm talking about, if you find this information valuable and useful to you, I hope you're subscribed to our channel. And check us out. Check us out on our website too, by the way, resultscommercial.com. Pay us a visit. We're happy to help in any way. Thanks for joining me today.